Hello, welcome back to Chapter 8 Notes. And so just a few additional points on target costing. Companies using, as I mentioned earlier in the other video, companies using target costing often institute cross-functional product development teams from engineering, marketing, and cost accounting. And again, if you can't design it for as specified for the target costing, you either have to reduce some of the features or change your desired profit margin. And of course, you can use continuous improvement methods to increase productivity and continue to eliminate waste to get down to that target profit. And in the long run, you do want to include both variable and fixed costs so that you can recover all your costs, okay? In order to attain those target costs, some companies might combine Kaizen or other continuous improvement methods. Those would be aimed at improving productivity. Cutting costs to hit the target profit could be very difficult. A product may be in development for a long time, and alternative designs may have to be evaluated over and over again. And you could also run into organizational conflicts. The burden of cutting costs could fall unequally on different units. For example, it could fall more on manufacturing than on marketing, and that can cause some conflict. All right? So now let's go ahead and talk about customer profitability, or CPM. Look over here, customer profitability measurement. Okay, so look at this. CPM is the analysis and reporting of revenues earned from customers and then the cost to earn those revenues. So with CPM, I'll jump down here. We're going to assign those indirect costs of servicing customers to the cost pools. Using cost drivers similar to what we did with activity-based costing, those costs are then allocated to specific customers. And subtract these costs and product costs from customer revenue to give an idea of customer profitability. So it is kind of similar to activity-based costing, what we did back in Chapter 6, except that rather than allocating the indirect cost to products, we're going to allocate them to customers. Okay? So let's go ahead and take a look at our example here on page 17 of your notes. We can look at our Delta products has the following costs. We have our orders processing cost per order. So what we're saying is what we probably did is we went back through and we said, well, how many costs do we incur to fulfill orders, to process orders, the total amount of costs, and then we would say, all right, we think we're going to fulfill 1,000 orders, for example. And then when we divide it, we get $5 per order. And then what we do is internally we say additional handling costs per rush order. If we have a rush order, it would be $8.50. And then internally what we have is $10. It costs us $10 for each customer service call. And then to deal with our customers, it's $2,000. Okay? So again, this is kind of similar to activity-based costing, where we would have gone through and developed these costs right over here by taking the total cost divided by the total orders. Or here, we would take our total cost for customer service calls divided by the number of customer service calls that we think we're going to have. Okay? And I do have a typo here. It says, in addition to these costs, product costs amount to 90% of sales. In the prior year, Delta had the following experience with Johnson Brands. We can say that they said, we're Delta, we're dealing with Johnson Brands, our customer, and we had $53,800 in sales. We had number of orders for 200, so Johnson Brands placed 200 orders. Of those 200 orders, 60% were marked rush, and then they also made 140 calls to customer service. Now let's go ahead and calculate out the profitability. We come over here, we have our sales, $53,800, and then what we have is our cost of goods sold, and that is our product cost. And the cost of goods sold is our product cost. So we're going to take $53,800 times 0.9, because it's 90%, gives us our $48,420. Okay? And then at that point, a lot of companies might just say, okay, it appears that Johnson Brands is a profitable account, because you can see our sales is higher than our cost of goods sold, our product cost for dealing with Johnson Brands. So we would conclude, okay, they're profitable. But the problem with that logic is that we haven't pushed these indirect costs down to the level of Johnson Brands, down to Johnson Brands, to figure out whether they're really profitable after we push these indirect costs down. Okay, so that's what we want to do now. We'll come over here and we'll say our order processing costs. And we can say, well, they had 200 orders, and each order costs us $5. So it's $1,000. Okay. And then we'll say rush handling, right? We'll say our rush handling. And we can say, well, we're going to say over here it's going to be our $1,020. And the way I got that is I said my 200 orders times 0.6, because 60% of them are rush, times our $8.50 per order, which is the rush cost per order. And then we can see our customer service here. Customer service calls. Well, they placed 140 calls to customer service, and if you looked up further up your page, it says it's $10 per customer service call, $1,400. And then what we have is our relationship management costs per customer. It's $2,000, so they're one customer, so we can say our relationship. We're going to say our relationship, which is $2,000. Okay. So now what we can do is we can see over here, we can say our total costs. Add up this plus this plus this plus this plus this gives us our total cost of $53,840. So now our profit on Johnson Brands is a loss of $40. So you can see they look profitable on the surface because we do cover our product costs, but then when we push down those indirect costs down to Johnson Brands, they're not nearly as profitable. And so that's why I think CPM is really interesting. Again, is similar to activity-based costing, but for customers. Okay. The last thing that we'll talk about, well, before we get into activity-based pricing, we may talk about some more factors here, comment some more on CPM. Some factors to consider with CPM: likelihood of customer retention, potential for customer growth, long-term profitability. Okay. And again, what we can say is some customers with established reputations can help generate sales from other customers, right? And some customers may be valuable because they provide product endorsements. So these are some of the things that we want to consider with reference to customer profitability measurement, not just looking and saying, okay, Johnson Brands cost is we're losing $40, but maybe that there is some long-run profitability for there, and there's some more customer growth. So we don't want to discontinue Johnson Brands as a customer, even though we're losing $40 once we push down the indirect costs, because there's room for growth and there's some long-run profitability. Okay. Some other measures that we might want to think of that will help our managers to improve customer profitability. Some things that we might want to look at for percent of customers who are not profitable, which is what we just kind of went through and calculated on how to do that. And then the dollar loss, so that's what we actually looked at too. And the average profit, we actually just went ahead and calculated that as well. We calculated the profit per customer for Johnson Brands, and we could just take an average of all our customers. We also want to look at percent of customers who return items, and what's the dollar value, with the thought this would be a leading indicator of revenue in the future, that if you have a lot of sales returns, that bodes poorly for future revenue. Okay? And then finally, the last thing that we want to talk about with reference to Chapter 8 is our activity-based pricing. I'm sorry about that, moving some of the papers around. So activity-based pricing would be an approach to pricing in which customers are presented with different prices for services that they request, in addition to the cost of goods sold that they also have to pay. This causes customers to carefully consider the services that they request. Activity-based pricing is also known as menu pricing. So we looked over here and we looked at this example. The figure below shows an example of activity-based pricing. We have a charge for internet orders of $1.25, charge for phone, fax, or mail orders of $4.75. We have a charge per line item per order of $1. We have a delivery charge. Okay, so what we're going to start to do, you look over here, if customers mail in orders, we're going to charge them $4.75, versus if they place them over the internet, we're only going to charge them $1.25. So we're trying to incentivize customers to go this route, presumably because it's more automated and therefore cheaper. Okay. So if we were to kind of look at this, sorry to shuffle papers around again, but reference to our Johnson Brands account, what we might actually want to do is start charging Johnson Brands for calls to customer service, or charging them, because remember, this is an internal charge. The way we got these are all internal charges. Those are not passed on to the customer unless we adopt an activity-based pricing scheme. So what we could say is we're going to start charging you each time you make a call to customer service, or each time you do Johnson Brands, we're going to start charging you each time you make a call to customer service, or each time you place a rush order, or each time you place an order. And by doing that, we'll actually start to recover some of these indirect costs. Now, something that to consider with taking that approach, of course, is that customers might object because the price of, might object to that. But some of the things that we might want to think about is maybe we can only use activity-based pricing on some of our least profitable customers because we're not so concerned if they go. And some other things that might happen if we implemented an activity-based pricing scheme is that we could encourage customers to limit the variety of goods that they order or to bundle them in larger orders. So that reduces our costs, and that's what's saying that fewer but larger purchases, because to basically buy in bulk, and so that also reduces our costs. Okay. So that concludes Chapter 8 notes, and so the next lecture video will be, of course, on Chapter 10. Thank you so much.